Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Navitas Semiconductor.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K with VIP indicators. VIP indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10 is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So right now, the biggest technology giants in the world are facing this terrifying physics problem.
Yeah, a literal meltdown.
Exactly.
Yep.
It's a problem that literally threatens to derail the entire artificial intelligence revolution for you, for me, for everyone.
Right.
Because the processing chips they are building, they're getting so incredibly powerful and requiring so much electricity that they are on the verge of literally melting their own data centers.
Traditional cooling systems are just failing. They can't keep up.
They really can't.
Yeah.
And the company claiming to have the exact hardware fix for this thermal meltdown, well, they just saw their stock surge over 400% year to date.
It's massive. And, when you see a chart print a vertical 400% green line, it immediately commands your attention.
Oh, absolutely.
But what makes Navitas Semiconductor so fascinating right now isn't just the sheer market momentum, it's the fact that they are aggressively ripping up their own foundation to chase this AI crisis.
Right.
They are undergoing a massive, honestly painful transformation. They're deliberately shedding their old low-margin business.
Which was mostly making fast chargers for your mobile phones, right? Consumer electronics.
Exactly. Phone chargers.
And they are executing a hard pivot straight into the absolute bleeding edge of high-power artificial intelligence data center infrastructure.
Yep.
But, operationally, shifting from consumer phone chargers to the critical power backbone of hyperscale AI data centers is a massive leap.
It's a completely different world.
It's not just a pivot. That's like trying to upgrade from powering a bicycle headlight to fueling a space shuttle thruster.
That's a great way to put it.
The engineering requirements are entirely different. If they mismanage this transition, they alienate their entire existing investor base.
It's an extreme leap, absolutely. But, they have to make it. The legacy consumer charging market is just a race to the bottom on price.
Right, highly commoditized.
Exactly. If you stay there, you just get crushed by cheap overseas manufacturing. The AI data center market, on the other hand, is a hyper-growth environment where thermal efficiency is literally a matter of survival.
So by abandoning the phone chargers,
By abandoning them, they free up every single ounce of their capital and engineering talent to capture a market where traditional silicon is physically failing.
because if traditional silicon is hitting a physical wall, we really have to zoom out and look at what that means for your portfolio.
Definitely.
If you see that 400% surge on your screen, your immediate internal thought is probably, oh no, I've completely missed the boat on this one.
Sure, that's the natural reaction.
But to figure out if you are actually too late, or if this is just the beginning of something massive, we need to understand the scale of the problem. All right, let's move into the wealth building context.
To understand the true scale, you really have to look at the broader macro environment. Specifically, we're talking about the historic acceleration of AI capital expenditures by the hyperscalers.
Right, the Amazons, the Microsofts, the Googles.
Exactly. These are the companies building the massive computing hubs. And the core bottleneck they're hitting right now isn't just getting their hands on enough graphics processors from NVIDIA.
Which is hard enough on its own.
It is. But the real bottleneck is physically powering those processors without burning the building down.
Right, because the power density of these server racks is just exploding right now.
It's unprecedented.
Historically, a standard data center rack used, about 1.2 kilowatts of power?
Around there, yeah. Very manageable.
Now, with advanced AI systems, we're talking about moving up to an unbelievable 1 megawatt per rack.
A full megawatt. It's insane.
Imagine taking a massive industrial power line and trying to shove it through the exact same physical space that used to hold a single microwave's worth of power.
It creates an acute, catastrophic thermal and density crisis inside the facility.
Literally melting the hardware.
Exactly. When you push a megawatt of electricity through legacy silicon chips, the friction creates immense heat. They will literally melt under the load.
So what's the alternative?
You need advanced wide bandgap materials, specifically gallium nitride and silicon carbide.
Okay, wide band gap. Explain that for us.
Think of traditional silicon like a narrow pipe with rough edges. When you push high voltage through it, the resistance generates massive heat.
Right.
Gallium nitride and silicon carbide fundamentally widen that pipe and smooth out the walls. They allow electrons to flow with almost zero resistance.
Which means less heat.
Which means they run exponentially cooler, they switch faster, and they take up far less physical space on the motherboard.
And that technological leap is exactly why the total serviceable addressable market, the SAM for this specific power sector, is projected to hit $3.5 billion by 2030.
It's a massive runway.
But, I mean, we need to talk about the reality of that timeline for a long-term investor.
Sure.
If the true revenue inflection point for these massive 800-volt AI architectures isn't realistically hitting the income statement until 2027 and beyond, how does anyone stomach the volatility of waiting years for that $3.5 billion market to actually materialize?
It's tough.
Because a lot of things can go wrong between today and 2027.
It requires extreme conviction in the underlying physics of your thesis. Yes, the volatility will be brutal.
Yeah.
But wealth generation during major structural tech shifts always requires sitting through the messy middle. The hyperscalers are laying the literal groundwork right now.
The infrastructure phase.
Right. The design wins, where tech giants actually choose which chips to put in their next-generation servers, those are happening today.
Even if the cash isn't flowing yet.
Exactly. The massive revenue always lags a few years behind those initial design wins.
And if that revenue is lagging by years, we need to know if the company can financially survive the wait. We have to see if the actual ledger justifies all this hype. Now let's look at the fundamentals.
Looking at their Q1 2026 earnings, they reported $8.6 million in revenue.
Okay.
That is an 18% sequential increase, and it beat Wall Street consensus estimates by 7.5%. They also posted a loss of 4 cents per share, which actually beat the consensus by a solid 20%. But there is a massive caveat that you have to understand when you read this report.
Which is?
Year-over-year revenue actually dropped 38.7%.
Yeah, that's the big one. You see a nearly 40% drop in revenue on a high-growth tech stock, and your immediate instinct is to hit the sell button and panic.
Absolutely.
But when you look under the hood, that drop is entirely intentional. It's the direct result of them deliberately chopping off that legacy consumer phone charger business we talked about earlier.
Exactly. It's a planned contraction.
What really matters is that underneath that top-line decline, their high-power AI market revenue surged 35% year over year.
And that underlying mix shift is everything. You cannot evaluate them on top-line revenue right now. Because they're focusing purely on high-power infrastructure, their non-GAAP gross margin actually improved by 30 basis points in Q1.
Which shows the new focus is much more profitable.
Right. And looking forward, they are guiding Q2 net revenues to hit $10 million, which represents 16% sequential growth.
But margins expanding too, right?
Yes, gross margins are expected to expand even further to 39.25%. And arguably the most impressive part of the ledger, they are guiding operating expenses to remain completely flat sequentially at around $14.5 to $15.5 million.
Okay, so they are scaling their revenue growth while keeping their expenses completely flat, which is the absolute dream scenario.
It really is.
And they are backing up this entire Navitas 2.0 transition with a fortress of a balance sheet. They ended Q1 with $221 million in cash and zero outstanding debt. Zero.
A completely clean sheet.
And the structural moat protecting that balance sheet relies heavily on their proprietary tech. They're the only pure-play company offering both gallium nitride, which they brand as GaNFast, and high-voltage silicon carbide, which is their GeneSiC tech.
And the efficiency of those specific chips is staggering. They can convert electricity with up to 98.5% efficiency.
Wow.
In a hyperscale data center, A mere 1% gain in efficiency translates to millions of dollars in electricity savings, not to mention the massive savings on liquid cooling systems.
Because there's less heat to cool in the first place.
Exactly. Because AI architectures are aggressively shifting to 800-volt direct current systems to handle those megawatt loads, Navitas is capturing about 30% of the entire power semiconductor bill of materials with their gallium nitride chips.
30% is a huge chunk.
And they get another 10 to 15% with their silicon carbide chips.
Add in the fact that they have deep, confirmed integration with NVIDIA's MGX platform, including the massive 800-volt Kyber system design, and the technological moat starts looking very, very real.
It's heavily validated.
But I have to stop right here and challenge their recent corporate finance strategy.
Okay, let's hear it.
If they already have $221 million in the bank, absolutely zero debt, and their operating expenses are successfully being held flat, why on earth did they just announce a $125 million at the market, or ATM, equity offering?
Ah, the ATM.
You don't dilute your existing shareholders by raising another $125 million right now unless you secretly think your cash burn rate is going to explode. Is this a strategic war chest or a massive waving red flag?
It is absolutely a strategic war chest, and here's why. In the semiconductor hardware industry, you raise capital when your stock is flying, not when you are desperate.
Okay, strike while the iron's hot.
Exactly. When your stock is up 400%, your cost of equity is incredibly cheap. But more importantly, it's about signaling to the hyperscalers.
How so?
If you are asking a multi-trillion-dollar tech giant to base their next 10 years of data center infrastructure on your proprietary chips, they need an absolute guarantee that you have zero liquidity risk.
Ah, they need to know you're not going bankrupt halfway through the build-out.
Right. That $125 million ATM offering proves to the market and to those hyperscalers that they will never run out of money to fulfill those long-term contracts.
Well, proving you can fulfill the contracts is one thing, but we need to know when those contracts actually hit the wire. That brings us to the catalyst timeline.
Over the next 3 months, the immediate focal point is Q2 earnings in early August.
Right around the corner.
The market will be laser-focused on seeing if they actually hit that $10 million plus revenue realization and prove out the margin expansion.
So August is key. What else?
Beyond that, management is heading into a series of highly anticipated investor conferences where they are expected to detail a massive $2.4 billion plus design win pipeline.
But the most specific needle mover that just crossed the wire is their new partnership with Cyient.
Yes, the India deal.
They are launching India's first gallium nitride power IC family, which consists of 7 new chips. They also just showcased an 800-volt to 6-volt GaN-fast power delivery board directly at NVIDIA's GTC 2026 conference.
The GTC showcase was huge.
And swirling underneath all of these official announcements, there is heavy, persistent speculation about strategic M&A.
Mergers and acquisitions are always the wild card.
There are whispers that legacy incumbents like onsemi or Infineon might target them for a buyout, alongside rumors of even deeper direct integration into upcoming NVIDIA rack architectures beyond just the MGX platform.
Now, regarding that Cyient partnership in India, it is deeply strategic on a structural level. It validates their intellectual property licensing model.
Instead of building their own factories.
Exactly. Instead of Navitas spending billions in capital expenditure to build their own manufacturing factories from scratch, they just license the tech.
Which keeps operating expenses flat.
Exactly. It taps perfectly into the geopolitical Make in India initiative, and crucially, it builds supply chain resilience outside of traditional concentrated manufacturing hubs like Taiwan.
Look, I understand the geopolitical safety of diversifying the supply chain. We all know the risks with Taiwan right now.
Right.
But realistically, is licensing technology to a partner in India going to move the needle on top-line revenue anytime soon?
Well,
Or is this just a perfectly timed PR headline designed to keep the momentum traders distracted while we wait for the real fundamental test at the August earnings call? Licensing agreements notoriously take years to show up as meaningful cash flow on the balance sheet.
you're right that it won't drastically alter next quarter's revenue print. You won't see a massive bump in August from Cyient,
So it is kind of PR.
but it materially lowers their long-term execution risk today. Hyperscalers demand secondary, geographically diverse supply channels before they sign massive multi-year contracts.
Okay, that makes sense. They need backup plans.
The signed deal proves Navitas can scale globally without blowing up those flat operating expenses we talked about earlier.
So the business is securing the foundation, but all of this has created some incredibly violent price action on the screen for investors. Now let's pivot to the chart.
The technical setup here is completely fascinating. The stock recently broke out to a fresh all-time high of $23.82.
Rice.
From a charting perspective, that puts it in what we call a blue sky state.
Meaning there's no ceiling.
Right. There is absolutely no historical overhead resistance. There are no trapped buyers from 3 years ago waiting to sell and break even the moment the price recovers.
But it hasn't been a smooth ride up. Following that $125 million ATM offering announcement, we saw a massive gap down, a brutal retest of lower support levels.
Yeah, the market hated the dilution at first.
Yet, despite that heavy pullback, it maintains incredible momentum leadership. It's frequently highlighted in market sweeps alongside other exceptionally strong momentum names like Liquidia and Beazer Homes.
It's got serious relative strength.
But here is the most dangerous, volatile piece of the technical puzzle. Short interest. Right now, short interest is sitting at a staggering 21% of shares outstanding and 28% of the tradable float.
That 28% short float is the absolute rocket fuel on the chart right now.
It's massive.
Think about the mechanics. When nearly a third of the available stock is sold short, it's like a crowded theater with only one exit.
And someone yells fire.
The moment positive news hits, like the Scient partnership or the NVIDIA board showcase, all those short sellers panic. They rush the door at the exact same time, desperate to buy back shares to cover their losing positions.
Creating a squeeze.
That dynamic creates explosive short squeezes, completely divorcing the day-to-day price action from the actual underlying fundamentals of the business.
And that dynamic is exactly why this is so precarious. If you are trying to build a stable, long-term wealth portfolio, stepping into a stock with a 28% short float is terrifying.
It's not for the faint of heart.
Sure, a short squeeze that drives the price up 25% in a single intraday session looks spectacular on a monitor.
We all love green days.
But the whipsaw on the way down is just as violent. That's like playing with matches in a fireworks factory. If your thesis relies on holding this stock until 2027 to see that massive revenue realization, getting whipped around by 20% weekly swings based purely on short covering mechanics is a massive psychological burden.
It is.
It can so easily shake you right out of a phenomenal long-term position.
It absolutely requires an iron stomach. You have to actively divorce your long-term thesis from the daily ticker tape.
You can't stare at the screen every day.
If you genuinely believe in the $3.5 billion total addressable market by 2030, you don't chase the 25% short squeeze spikes. You use the extreme volatility to your advantage.
Buy the dips, essentially.
You systematically accumulate shares during the inevitable violent gap downs, just like the one we saw after the ATM offering.
So retail investors have to be careful, but what are the big players thinking behind closed doors? So what does market sentiment look like?
The overall mood on the street is fundamentally bullish, though there is a healthy layer of caution regarding the immediate dilution from the new shares.
Which is to be expected.
Looking at the analyst actions, Needham recently maintained a buy rating, but more importantly, they significantly raised their price target from $13 all the way up to $21.
And we are seeing confirmation of that bullishness on the institutional and insider front. They recently appointed a new CFO, Tanya Stevens.
That's a key move.
Bringing in new financial leadership at this specific moment generally signals that insiders are gearing up for long-term equity value creation, preparing for that massive growth phase.
Absolutely.
Furthermore, look at who handled that $125 million ATM offering. Heavyweight banks like UBS and Craig-Hallum.
The institutional footprint there is the tell. UBS and Craig-Hallum do not underwrite a $125 million offering and risk their own capital unless they have quietly lined up heavy institutional buyers on the back end.
Buyers who want a piece of the action.
Buyers who are starving for pure-play AI infrastructure exposure. The raised price target from Needham confirms that Wall Street analysts are finally starting to model in the massive $2.4 billion design win pipeline, rather than punishing the stock for intentionally dropping the legacy phone charger business.
But are they really modeling the pipeline, or they're just getting swept away by the narrative?
What do you mean?
Because Wall Street is currently caught in an undeniable euphoric AI hype cycle. Literally anything that touches a data center is catching a massive bid right now.
That is true. Everything is running.
Are these analysts actually modeling out realistic, tangible cash flows for 2027? Or are they just slapping a $21 price target on it to generate trading fees, completely ignoring the astronomical valuation multiple required to justify that price?
It's a valid concern. The multiple is high.
Because if we're going to talk about astronomical multiples, we need to balance the scales. Now let's talk about the risks.
The valuation risk is front and center. The stock is currently trading at roughly 135 times trailing sales.
135 times sales.
To put that completely in perspective, at 135 times sales, the market is pricing this stock as if flawless, uninterrupted success over the next 5 years has already happened.
Everything has to go perfectly.
There is zero margin of safety built into that price. If they experience any slight delay in converting those design wins into actual shipped products, that valuation multiple will violently collapse.
And right alongside valuation is the dilution risk. We keep mentioning the $125 million ATM offering, but we need to quantify exactly what that means for you as an investor. That introduces over 13% share dilution to existing stockholders.
Your slice gets smaller.
Your personal slice of the pie just got 13% smaller, which is exactly why the stock tanked on Tuesday, May 12th.
And finally, the most existential threat is the severe competitive execution risk
Of the big boys. They're going up against deeply entrenched legacy semiconductor giants like Texas Instruments, Infineon, and onsemi.
The competition is undeniably fierce, and those legacy giants have infinite resources. But here's the critical counter-argument you have to understand. Power semiconductors represent less than 1% of the total system cost of an AI data center.
A tiny fraction of the budget.
But that 1% completely dictates the total operational efficiency of the $40,000 GPUs they are powering.
Right.
Hyperscalers are not going to optimize for cheapness on a component that literally dictates the thermal survival of the entire facility. They will choose the absolute best 800-volt technology available. And right now, Navitas' dual gallium nitride and silicon carbide portfolio is the superior architectural choice.
I understand the technological superiority today, but logically, if you are going up against a titan like Texas Instruments, who has decades of established foundry relationships and massive global distribution networks, what physically stops them from simply outspending Navitas?
Well, it's not that simple.
Texas Instruments could easily dedicate billions to research and development specifically for gallium nitride. What stops them from suffocating Navitas until the smaller company simply runs out of its $221 million war chest?
It comes down to switching costs and speed to market. Navitas has secured a massive first-mover advantage with that NVIDIA MGX integration.
Being first matters.
Once a hyperscaler designs an incredibly complex, multi-billion-dollar server farm around your specific thermal power architecture, tearing all of that out to switch to a slightly cheaper Texas Instruments alternative 3 years from now is completely cost-prohibitive.
The switching costs are just too high.
The lock-in effect in this space is profound. Once you're in the rack, you stay in the rack.
So if the lock-in effect is profound and the risks are quantified, we need to bring this to a conclusion. So with everything on the table, what's the final verdict?
Based on the research, this setup generates a bullish score of 8 out of 10.
8 out of 10.
The ultimate verdict here is that Navitas is the premier pure-play lever on the AI data center power crisis. Yes, you are taking on immediate, painful dilution.
The 13% we talked about.
Right. But their fortress balance sheet, zero liquidity risk, deep NVIDIA integration, and advanced 800-volt capabilities position them almost perfectly for the unprecedented AI infrastructure scale-up we are witnessing right now.
And for your timeline, the target horizon here is a multi-year hold, specifically looking at a 2 to 3 year window.
It is entirely about patient capital. The design wins they are securing right now will not convert into massive production ramps until 2027 and beyond.
You have to wait for the factories to actually get built and running.
You have to be willing to look past the short-term noise and focus on the fundamental physics of the problem they are solving.
And I want to anchor that excitement with a final practical warning for you. A multi-year hold means enduring significant short-term pain. When you hold a stock trading at 135 times sales with a 28% short float, you are going to experience terrifying red days.
It's guaranteed.
Building wealth requires careful risk management, sizing your positions appropriately, and having the sheer discipline to hold through the turbulence when the underlying thesis hasn't changed. And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is Grow $110K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.